Welcome to The Explainer, fellow investors. Grab a seat. Today, we're acting as a value investment committee to audit CATY General Bancorp, ticker CATY. We're going to put this regional bank through the ringer using Warren Buffett's legendary framework. That means breaking down their business quality, diving deep into the financials, and running a rigorous valuation based strictly on their latest filings. Let's get to work.
First up, the ultimate Buffett query. Is this a wonderful business at a sensible price? It's a simple question, right? But to figure out if KMTE actually meets our strict criteria for a long-term portfolio hold, we really have to strip away all the noise. We need to look closely at their competitive advantage, how management runs the show, and of course, the cold, hard numbers.
So, do they have an economic moat? Well, looking at their niche focus versus broader industry dynamics, we're looking at a moat that's narrow to none. See, they do have a highly focused presence in dense Asian-populated markets across places like California, New York, and Texas. That cultural niche and those deep relationships absolutely give them a solid foothold. But it's still regional banking. There are almost zero switching costs, making it a notoriously commoditized industry.
Now, let's look at the engine of that business, their deposit mix. As we can see here, they fueled an impressive $20.7 billion in total deposits by early 2026. Notice how a hefty chunk of this is locked up in time deposits and money market accounts. Understanding exactly where this money comes from is absolutely crucial because it sets the entire baseline for their cost of capital and their lending firepower.
Let's transition to the financials and see how this all builds out. Notice their incredibly consistent return on equity. It was hovering above 21% in recent full fiscal years before settling to around 11.88% in Q1 of 2026. But here's the catch. Their PE multiple has definitely expanded, climbing from a bargain basement 8.45 back in 2022 to 11.77 today. The real standout here, though, a staggeringly low debt-to-equity ratio of just 0.04.
40.35%. Now, why does this matter? This is their Q1 2026 efficiency ratio. In the banking world, anything below 60% is considered solid, but hitting roughly 40%, that is borderline obsessive cost discipline. It basically proves CATY General is running an incredibly lean ship, converting revenue directly into profit like absolute pros.
But here is the friction. A 97.0% loan-to-deposit ratio. Yeah, they're wildly efficient at keeping the lights on cheaply, but a ratio this high indicates super tight liquidity. It means nearly all of that deposited cash we talked about is heavily deployed out into the market as loans. They are running this engine hot, folks, leaving a very small cushion if there's a sudden demand for liquidity.
Which brings us to a major point of concern on our credit risk radar, a sudden spike in credit loss provisions. In late 2025, they literally tripled their provision for loan losses to $28.73 million. By Q1 2026, their total allowance for loan losses ballooned to $208.8 million, with non-accrual problem loans sitting at $89.0 million. Bottom line, management is actively bracing for some serious turbulence in that $20 billion loan portfolio. Okay, before we judge management too harshly for that tight liquidity and those rising provisions, let's actually hear from the CEO, Chang M. Liu. He clearly states they are intentionally choosing defensive credit quality over aggressive loan volume right now. This tells us we have a management team that's acutely aware of the messy macroeconomic environment, and they're willing to pull back the throttle to protect the balance sheet. However, as a value committee, we've got to call out this glaring disconnect in management alignment. Look at this. Executives hit internal targets and scored massive bonuses. We're talking 110 to 120% of their targets. Meanwhile, external shareholders were left holding the bag with a total return of just 4.64%, while the broader regional bank index surged 28.85%. A massive payday for them and barely a rounding error for you. Not a great look? Pivoting from that, let's look at broader capital allocation. They actually do aggressively return value to shareholders. They just finished a $150 million buyback, and the board already approved another $150 million. Plus, they pay a steady $1.52 annualized dividend, yielding about 2.84%. Though, on the governance front, there's a quirky $198,000 related party office lease paid to an entity controlled by a director. It's small potatoes, sure, but exactly the kind of thing that warrants a watchful eye. But even with those governance quirks and the rise in credit provisions, the data here shows that from a pure solvency standpoint, CATY remains fundamentally rock solid. Just look at that Tier 1 risk-based capital ratio of 13.27%. That is well above the 8.5% regulatory requirement. The foundation here is incredibly stable. All right, let's talk price tag. Looking at historical multiples, we've got a PE of 11.77 and an EV to sales of 3.61. Pretty reasonable. But to complete our Graham intrinsic value formula, we'd normally factor in the current AAA corporate bond yield. Since that specific macro data point isn't in these filings, I'll actually need you to provide that yield if we want to run the full Graham model. For now, we'll lean heavily on our discounted cash flow models instead.
Working with those DCF models, and assuming a highly conservative terminal growth rate of 2%, we can plug our data right into this valuation matrix. With the current stock price sitting at $57.04, we use this to define our target buy price. Remember, as strict Buffett disciples, we demand a 25 to 30% margin of safety below base intrinsic value before we even think about pulling the trigger. So let's summarize our thesis for the committee. Does CATY pass the Buffett checklist? 1. Is it understandable? Yes, traditional regional banking. 2. Durable moat? Narrow at best. 3. Consistent high returns? Yes, efficiency and ROE are top tier. 4. Able and honest management? It's mixed. They're operationally prudent for sure, but that executive pay misalignment is a definite red flag.
Which brings us to the final verdict. I leave you with this to chew on. Is CATY General's absolute world-class operational discipline enough of a fortress to anchor your portfolio? Or do those emerging credit cracks and the executive pay disconnect keep this bank firmly on your hold list? Thanks for joining this explainer, and as always, keep hunting for that intrinsic value.